welcome to the deep dive. Today we've got a listener-shared stack of material that is, frankly, essential for anyone in the crypto space.
It really is.
It all boils down to one high-stakes question.
Yeah.
How do you survive in a market where, let's be honest, most assets fail, and a lot of them fail on purpose?
And that's our mission for this deep dive. We're getting into the technical reality of intentional fraud, the rug pull scam.
Right.
And to do that, we're using the 2021 Squid Game token, or Squid Study, as our main case study. It's just a perfect, almost textbook illustration of how pop culture hype gets weaponized against investors.
Exactly. And we're not just, telling a story here. We are building a defense mechanism for you. Because when you look at the stats, it's pretty sobering.
It is.
Our sources show that at around 17,000 cryptocurrencies in 2025, over half of them have already failed.
50%.
Which means due diligence isn't some optional extra. It's the cost of entry. So we need a solid checklist. And that starts with understanding how the code itself becomes the crime.
Yeah, we'll pull those technical mechanisms out of the shadows, and then we'll zoom out and look at the bigger picture, the economic and structural flaws that really allow this whole industry of quick scams to thrive.
You mean things like volatility?
Well, yeah. The inherent volatility of these unbacked assets, Bitcoin's volatility can be 4 times higher than gold or stocks. It just creates the ideal environment for a sudden collapse.
Okay, so let's start with the ultimate cautionary tale. Let's unpack the anatomy of the Squid token scam.
Perfect place to start.
So, late 2021, Netflix's Squid Game is everywhere. It's a global phenomenon. And almost overnight, a crypto token based on the show pops up.
Marketed as a play-to-earn token.
Right, tied to some fan-made online game.
And this is just a classic lesson in how these scams leverage, cultural urgency. And critically, FOMO. Fear of missing out.
People were already emotionally bought in.
Absolutely. So the coin launches, and within days, it gets this rapid, dramatic traction. It just soared. It hit a peak valuation of $2,861.
Per coin.
Per coin. That's a surge of thousands of percentage points in just 1 week.
And that's a completely baseless surge, right? Driven purely by the story, by the hype. If you were watching your investment climb like that, you'd feel like a genius.
Of course. You'd think you were finally ahead of the curve. And that's the setup for the trap. The hype was so extreme.
But there were warning signs.
Oh, there were huge red flags right from the start. Several early reports, they're in your materials, noted that investors who had bought in were having trouble selling. But by the time most people noticed that, the token was already near its peak.
And that brings us to the crucial part, the core of the fraud. This wasn't a market failure. This was an engineered trap, a classic digital honeypot.
Correct. It was a one-way street. You could buy Squisquieta, but you were completely unable to sell. The code wouldn't let you. So when the developers saw the hype had peaked, they pulled the rug.
And what did that actually look like for investors?
Instantaneous devastation. The value plummeted from, $2,861 down to basically zero in a flash. The developers drained all the pooled currency from the exchange. They just took the money and disappeared with an estimated $3.38 million.
And the project itself?
Gone. The website, the white paper, all the social media accounts, just taken offline. The silence that followed was deafening.
It's just astonishing how fast it all happened. But the key question here is the technical one. How can an asset be bought, have a liquid market, but then be totally unsellable for everyone except the people who created it?
That's precisely the right question, and it points to the deliberate manipulation of the smart contract.
The code that governs the token.
Exactly. In the Swipe scam, that smart contract was designed with a very specific backdoor.
Which was?
It was a transfer limitation. Basically, only certain pre-approved wallets, the developers' addresses, were allowed to use the sell function.
So everyone else was blocked.
Everyone else was blocked by a programmatic restriction. Analysts call it a trading freeze. You put your money in, but the code literally refuses to let you take it out.
So the buyer is filling this pot with valuable currency, like ETH or BNB, and the developers have just built their own digital siphon to drain it whenever they want.
That's a perfect way to put it. The honeypot name is perfect because it lures you in with something sweet, only to trap you. But the trading freeze, while famous, is just one of several techniques developers use.
So there are other ways they can rig the code.
Oh, yes. There are a few major technical dangers you should always be looking for. All of them center on the creator reserving some kind of unilateral control.
So what's the biggest one? If I were looking at the code, what screams scam?
The biggest is probably the liquidity pull mechanism. The creator hides an owner-only function, Sometimes they'll label it something that sounds harmless, but it lets them execute a single command, like remove liquidity.
And that's the classic immediate rug pull.
It is. They drain all the base currency, instantly collapsing the market if there's nothing to trade your token for.
It's worthless.
Exactly. It's the digital version of the bank manager locking the doors and running out the back with the cash.
Okay, what else?
Then you have something a bit more subtle, but just as devastating. Unlimited minting.
Creating new tokens.
Creating new tokens out of thin air. There's hidden code that lets the owner mint as many as they want whenever they want, so they can just flood the market with their new supply, which completely dilutes the value for every other holder. Then they just dump their stash and run.
It feels like a smash and grab.
It is. Which leads to the third maneuver, what some call the soft rug. This is done with exorbitant fees.
How does that work?
Instead of an instant crash, the developer suddenly uses an owner-only function to crank up the transaction fee to an insane level, say 99%.
So if I try to sell $1,000 worth of the token, $990 goes straight to the developer as a tax.
Precisely. It makes selling so costly that it's pointless, effectively freezing everyone's assets. The Fair Moon token scam did this. They raised the tax to 100% right before they vanished.
It sounds like the speed of these crimes is only increasing. The source have pointed out that the timeline for these scams is getting shorter and shorter.
It absolutely is. Rug pulls became the go-to scam in DeFi. They accounted for 37% of all crypto scam revenue in 2021. That's $2.8 billion stolen.
And the lifespan.
That's the most telling part. The average lifespan of a crypto financial scam in 2021 was just 70 days.
70?
Yeah, down from 192 days the year before. It just reflects a pure smash and grab mentality. Maximum hype, maximum speed, quick exit.
It's hard to talk about these mechanisms without also talking about the environment that lets them happen. So let's shift from the criminal mechanics to the structural weaknesses that allow over half of these projects to fail in the first place. Why is this market just so fragile?
The fragility, it's really rooted in the absence of intrinsic value for most of these assets. When you buy a share of stock, you're buying a piece of a business, a claim on future cash flow.
There's an underlying value proposition.
Exactly. Most unbacked tokens have no such anchor. They don't represent ownership of anything tangible.
Well, their price is just speculation.
Right. To sustain their price, they require a continuous, ever-increasing flow of new money. If that inflow of new investment stops, the whole thing just collapses, which is why they function a lot like Ponzi or pyramid schemes.
That instability seems to lead directly into what our sources called the broken token problem.
Yeah.
The idea that the asset itself is fundamentally misclassified.
This is such a crucial concept. Most of these things are marketed and traded like they're equity, investments that will make you rich, but legally they're often classified as utility tokens.
Which should function more like airline miles or a gift card, a way to access a service.
And that disconnect is just poisonous.
Okay, let's use that airline miles analogy to really nail down the flaw here. Why is buying 5,000 airline miles different from buying a utility crypto token?
It's all about accounting. When an airline gives you 5,000 miles, they don't treat those miles as an asset. For the airline, those miles are a liability on their balance sheet.
An obligation.
An obligation for a future service. They owe you a seat on a plane. They record it as a liability, which is just sound accounting.
So what's the backwards accounting that crypto projects are doing?
They do the complete opposite. They create these tokens out of thin air, which are functionally just promises of a future service liability, and they put them as assets on their own balance sheet.
They're literally booking their future debts as current wealth.
Yes. And you can see how that creates completely backwards incentives. Management should be focused on building a real service to drive utility.
But they're not.
They're not, because their asset value is tied to the token price. So they become intensely focused on pumping that token price through hype, manipulation, whatever it takes. They're optimizing the speculative vehicle, not the business. And that guarantees instability.
That really connects the dots between the outright scams and the systemic failures.
Yeah.
So given this landscape, we need to focus on defense. Let's transition to the most actionable part of this, the due diligence checklist you can use to protect yourself.
Okay, so these 5 checkpoints are the absolute minimum you need to do.
Let's hear them. Checkpoint 1, team transparency. This seems foundational. Is the core team doxed? Meaning, are they publicly known and verifiable?
Right. Do they have a real reputable track record? If a project is run by anonymous accounts, it is a massive red flag. An anonymous team can pull the rug with zero accountability. It's why we still don't know who the screw-eyed developers were.
Makes sense. Checkpoint 2, verify utility. You have to look past the buzzwords. Does this asset actually solve a real problem?
Or is its whole pitch just about being the next 100x moonshot, you know? Long-term value requires a genuine use case. If you can't explain what it does in one simple sentence, you should be extremely cautious.
Checkpoint 3, audit the code and verify the audit. This one hits the technical side directly. Has the smart contract been audited by a reputable independent firm?
And if they skip the audit, they're hiding something. It could be incompetence, or it could be a malicious backdoor. And crucially, if they claim they have an audit, you have to verify that firm is real and independent.
And even then, you need to check that the audited code is the code that's actually running.
Yes, you check the code on the Blockchain Explorer. It's the public record. If the code is unverified there, it's just too risky.
Okay, checkpoint 4. Check liquidity and token distribution. This requires a bit of digging.
It does, but it's vital. First, is the liquidity locked? If the developers can just pull the funds out at any time, they probably will. Second, look at who holds the tokens. If a couple of whale wallets, especially the first one, hold a huge majority of the supply, that is a major danger signal.
Because they can dump it all at once.
And crash the market. You also want to look for decent trading volume. If the 24-hour volume is super low, you could get stuck in an illiquidity trap. You might want to sell, but there's just not enough buyers.
All right. And finally, checkpoint 5, scrutinize promises. This is the common sense check that FOMO makes us forget.
Be very wary of projects promising guaranteed outsized returns or roadmaps that just seem impossible. Unrealistic marketing, constant hype with no substance, these are the linguistic patterns of a scam.
If it sounds too good to be true,
it almost certainly has a honeypot built into it. You have to prioritize skepticism over hype. It's really the only defense.
So to wrap up, we've covered the brutal squad trap, we've dissected how code is literally weaponized, and we've analyzed the financial absurdity that dooms so many projects from the start. That brings us to our final provocative thought for you to consider.
The original powerful vision of crypto was code is law, right? A system built to replace flawed human trust with immutable, verifiable technology.
Right, a trustless system.
But when we look at the sheer scale of this rug pull problem, where the code itself is intentionally programmed with backdoors and traps designed to commit fraud, what does that really imply about the sustainability of a system whose foundational element, trustless code, is so routinely used to steal millions?
Something to mull over as you research your next asset. Vigilance is your strongest asset in this space. Thank you for diving deep with us.